Hey, what's going on, everybody? Hope you're having a good day as always. My name is Michael and thank you so much for joining me. So today I want to have a little bit of a real estate conversation with you guys and discuss what's coming down the road with rate changes, because that has such a huge impact on first-time home buyers, or really just buyers in general. And even though I'm going to be talking about how this affects real estate specifically, it's going to impact everything from personal loans to car loans, and pretty much anything loan related. So that's what we're going to talk about today. Hopefully, if you guys are at all interested or considering buying your first home in the future, this will be of some value. If you've got any other questions that you want to see addressed in the future, put it in the comment section down below. Let's go ahead and get started. Now, first off, a lot of you guys probably already know that the Federal Reserve is increasing interest rates, which is going to cause commercial lenders and consumer lenders to increase rates as well for their loans, right? So specifically, this is why I said it's going to impact all loans in the future. Rates are going up, right? You can't get the same mortgage loan rate that you could 2 years ago. You're not going to be able to get the same car loan interest rate that you could 2 years ago, right? That's just what's going on. And what this is doing for a lot of people is removing a lot of their purchase power. And I say that because mathematically, a higher interest rate, especially on a mortgage, is going to have a much bigger impact than you would think. And so what I did was I used pretty much a 2-day example of what's going on, and I want you guys to see how this impacts first-time home buyers. So what I did is I made a scenario of someone who's looking to purchase a house, right? Let's say that no matter what, they're going to be spending on their loan $250,000, right? What is the difference between a 4.25% mortgage loan, and I am using a 30-year term here, and a 5% interest rate? So really, it's just 0.75% different, right? 4.25 or 5%. It doesn't really seem that big, but it does make a much bigger difference than you would think. All right, so first off, if you were to look at a $250,000 loan at 4.25% interest rate on a 30-year note, that's going to mean a monthly payment of $1,230. Now, if you were to change just the interest rate, right, again, from 4.25 to 5%, that is going to bump the monthly payment up over $110 a month. Now, that may not seem like a huge deal, but at the end of the day, if you consider that I'm potentially going to have this property or this loan for decades possibly, right, that is a huge difference year to year, month to month. And considering that most first-time home buyers aren't in a position where they can just afford to spend an extra $100, no big deal, right, this is going to make a big impact on whether people buy or not, or how much they can afford to buy, right? Again, it's about purchasing power going down with these increasing interest rates. Now, even though that, again, that $110 may not seem like a really big deal, I want to put this another way. Let's assume that you have a set spending amount, right? Let's go back to that $1,230 amount, okay? Let's assume that, okay, that is you can't spend more than that per month. That's your max expenditure for your principal and interest payment for your mortgage loan, right? Well, let's say that, okay, well, I can't go past this, and now that rates are at 5%, how much can I afford to buy now? Okay, because this is another interesting way of putting this data. Okay, if you were to keep the monthly payment the same and the interest rate at 5%, well, that means that you can now only afford to spend $230,000 on a loan. So you're going from $250 to $230, right? So a 0.75% interest rate increase has roughly an 8% change in your purchasing power, right? That is a big difference, $20,000. Okay, so if $110 per month didn't seem like a big increase, hopefully you can see that $20,000 is a big difference when it comes to purchasing power for a home, right? What if your dream house was a $248,000 home, and now you can only afford to spend $225,000? You missed out on your dream home simply because the interest rates raised just, less than 1%. Right? So this has big impacts on our finances going forward. And again, even though I'm talking about this in a home loan scenario, this is going to impact personal loans and auto loans, credit cards. Everything is going to naturally be going up. Now, sure, other beneficial rates are going to be going up as well, but again, if you are at all considering purchasing a home, let's say in the next year or so, this needs to be in the back of your mind. Because a lot of people that I speak to are really, really excited about purchasing their first home or purchasing their next home, let's say like a year from now or 6 months from now. A lot of these people are trying to work on credit issues so they can be in a better position to be able to buy in that time frame. right? Well, if they don't understand what's going on with rates, they may just assume that their purchasing power is going to be the same thing this time next year, but that's probably not going to be the case, okay? So if you are at all working on your finances, maybe your down payment amount or your credit score or your total debt to income ratio, so you can be in a position to buy later on, you really, really do need to be focusing on this now so you don't have to pay an even higher rate in the future. Because if the Fed is going to be consistently increasing rates, right, it may not stop at 5%. It could go to 5 and 5.5 and 6. Like if you look at Fannie Mae national mortgage loans average over the past 20 years, like they've been up to 7%. Right? So this is going to be a big change for a lot of buyers. I would encourage every single person who's thinking about buying to really do their due diligence, do their homework, so they can hopefully get the lowest possible interest rate that they can. Because the whole 3.5% rates, those aren't happening anymore. You're not going to get a 30-year mortgage with that type of rate anymore. And so we all need to do our homework to put ourselves in the best financial position in the future. So that's what I want to talk about today. Just a really quick nerdy math video for you guys. Again, hopefully it helps out. But if you've got any other questions, whether it's real estate related or credit, debt, anything personal finance related, I'd love to answer them. Put it in the comment section down below, or feel free to email me anytime at commonsensemike@gmail.com. Also, if you feel like supporting the channel directly, I've got 2 ways of doing that down below. That is through the Amazon link and the Patreon link. I would love it if any of you guys supported me in any way. But thank you so much for watching. Take care. Don't forget to like, subscribe, comment, share. You guys know what to do. But I'll see you guys next time. Have a good one. Hey guys, I know I just said this stuff, but let me say it again. Thank you so much for watching this video. I appreciate all the support that you guys give me. And to support you, here's 2 more videos that I've made in the past in case you haven't seen them. Don't forget to share these with your friends and family so we can help all the people achieve their financial goals. Likewise, if there's anything that you would want to see made that you haven't seen thus far, definitely don't hesitate to let me know. But thanks again, take care, and have a good day.